Hello, guys. Should I do my dance? It's going to be the Mark and Mark Show. Your two favorite Marks, your favorite broker, your favorite lender. So I'm about to see if we can get this going tonight. All right. We can do this. See if we can do this. Fingers crossed. There we go.
So I think it must be the iPhone for me.
Must be the iPhone. There you go. I can see you.
All right, we're even going to use the light. That's good.
So Mark has 40 years of experience in mortgages and 0 with Instagram, right?
Yeah. Negative.
We're going to be talking mortgages, rates, walking through everything tonight. Talk about some different programs.
Well, we may just hold it.
No, it's open now.
Oh, looks like you are paused. I don't know.
It says on pause. Hit live again.
There we go. There we go. There we go.
Is that better?
Yeah. Yeah.
Hey, it's perfect. See,
See,
now that we need you to get an iPhone. That's the next thing we got.
I think so, or we'll just do it on her phone. Yeah.
Save some money when we can. So, hello everybody out there. I think we got it together. This is going to be a fun and exciting show. We're calling it the Mark and Mark Show.
Yeah.
Your two favorite Marks.
I like the sound of that.
We'll have to maybe once we get this all together, we'll have to have like a weekly.
M&M. How about M&M?
Yeah, we'll have to have a weekly show or something.
Yeah.
But for the audience out there, I'll do a little introduction. So, guys, this is Mark Scarratt. He's with Ameris Bank. Him and his wife are fantastic partners of ours. They were actually the presenters, especially Mark with GreatHomesATL University, which was our first class that we did this past February. And I don't know if you saw, Mark, but we actually made it into a book.
Wow.
That is, I think it's like 63 pages. And we're actually going to be making it available for you guys to purchase a couple ways. You'll get a free copy digitally when you do a consultation with Mark and Curt. And we also going to have it for sale actually on Amazon in the coming weeks as well. So, Mark, you want to tell the people a little bit about what your thoughts were for the very first GreatHomesATL University? I thought it was a great turnout.
I thought so too. We had a packed room. And I think it went well. I think everybody involved did a great job. I mean, Jim was great.
Yep.
Kurt was great.
Yep.
Mark was good. But I was very pleased with how it turned out. And I think that we gave a lot of helpful information to people that maybe, don't know how to go about, finding and financing a home.
Absolutely. Absolutely. And so what we wanted to do for tonight's show, the Mark and Mark Show, I want to start by breaking, just announcing at the beginning, we will be talking about an exciting new down payment assistance program, one that they already have, and maybe a couple more sprinkled in. But I think overarching at the very beginning, we should do a little education about rates historically, if the Fed is even involved in this, and just explain to people as they're watching shows like CNBC, those channels, as they're watching the nightly news, as they're hearing all this data that's coming in and why interest rates aren't coming down. So I'm just going to give like a little bit of a overarching background, and then Mark, you can kind of get into the nuts and bolts of treasuries and all that kind of stuff. But overarching, guys, rates have been in the high 6s to the mid 7s over the last couple weeks. But before you tune out, we're going to talk about ways to get that down, but also some of the programs that are going to be able to assist you with that. But as if we look holistically, since they were reporting rates and people were buying homes in the 70s, 80s, all the way to today, where rates are, they're not like at literally an all-time high. If you
No,
ask your parents in the 1980s, they were buying rates and buying houses with 11, 12, 13, 14, sometimes even higher percentage points. Now, what you want to understand when it comes to mortgages and rates and when to buy a home and all that, people always ask us, and they're probably going to ask us throughout the night, when do you think our rates are going to come down? When do you think, all these type of things? And I want you to understand when you buy a house, right, you're typically, not all the time, but typically taking out a 30-year mortgage, right?
yeah,
So you can imagine in over 30 years, if everybody just waited for the perfect scenario to happen, right? In the 1980s, we had oil and gas issues. We had recessions during, we've obviously all these years gone through wars, and we're seeing that in the world now. It's the world we live in. We've gone through 9/11. We've gone through the Great Recession back in 2008, 2009. We
mm-hmm.
went through, obviously, COVID in 2020, and rates were absolutely at a historical low. Why? Because we were in a pandemic. So, Mark, if you could jump off and just kind of explain to people, without getting too wonky out there, but what they're seeing in the news, how interest rates are tied into all this economic data that is, that they're being witnessed to every day on the news.
Sure. Well, the primary tool of the Federal Reserve in combating inflation is to raise rates because it typically will slow down an overhot economy. And when that happens, rates fall. The Federal Reserve has aggressively raised their Fed funds rate over the past, I don't know, 2 years now.
Yeah.
And the reason you're not really seeing them fall is because even though inflation has improved, I mean, it started at over 9%, it's down to, 3.5, 3.6, but the Fed has a target of 2%,
Right.
and they want to try to get, the inflation rate down to 2%. Right now it's 3.5. I think when we started this year, most people would have told you, I mean, most people in the industry would have told you that they expected the Fed to start cutting rates this year. Now, last month's consumer price index, and the consumer price index is the level of inflation, really. I mean, that's the primary barometer of inflation, was surprisingly up. They expected a certain number. They thought they expected it to come down, and it went up slightly. It wasn't a lot, but it was enough to make the financial markets think that the Fed, before they were looking at them probably cutting rates in June, and now they feel like that they'll cut later in the year.
Right.
Now, the things to look out for, there's two things that they're really looking at now. They're looking at the consumer price index. Like I said, that comes out once a month. So the consumer price index for March came out a few weeks ago. So the consumer price index for April will come out. Generally, it's in the first 10 days of May. Now, certainly if you see that number come down, then what would happen is, the interest rate market does not really wait on the Fed. If they feel like the data suggests that the Fed will cut rates, they go down that day. So even if the Fed, was not going to cut rates until July or August, if they felt like confidently that they were going to do that, rates would come down that day. So we do have a chance that, when the consumer price index comes out for the month of April, that if there's some improvement in that, we'll see rates come down. Now, the other thing is they're looking at employment, and, it's very good for the economy, but unemployment is still very low. And there's been a lot of folks that felt like that the employment market would run out of gas, but so far it has not. Now, it wouldn't take much, and that's another number that if you saw unemployment go up some, that would indicate a rate deduction. So those are the two numbers to really look at. You know, you may see that on CNN Money or some other financial network, but they're always going to come out when that report comes out. The unemployment comes out the first Friday of each month. So the first Friday in May, you'll get the unemployment report. And if that shows unemployment increasing even slightly, I think it would cause rates to come down.
Exactly. And I think that, we all feel the pain of inflation. We all feel the pain of higher prices. But I want to explain to the audience out there, because there's so many words that people use, like they're waiting for the housing market to crash. They're waiting for rates to just tumble. And I want you guys to understand, like we talked about, a mortgage is over a 30-year period. If you just think about what house prices were in the 1990s and early 2000s and where they are, I ask you, where do you think that they're going to be 10 years from now, 20 years from now, 30 years from now? So the interest rate is something that I hate this phrase of like, marry the house, date the rate, because at the end of the day, like you have to find your affordability. But just know that you're probably paying currently at the higher end, and there is hope for it to come down. And when they do, you'll be in a position probably to save some money by refinancing, down the road. But in the global economy, the United States is doing excellent when you compare it to other industrialized nations. You think we're really fighting really hard at that 3.5% inflation rate. They're struggling big time in Europe, right? Russia and all
Sure.
these geopolitical areas, right? So the good news, guys, on one end of the spectrum is that you have a job. Hopefully you do have a job, because the employment numbers are really strong. So you really don't, for the betterment of the economy, don't want people to just start losing their jobs. That's going to exacerbate a whole bunch of different industries. But what you want to do is deal with the realistic expectation of the market right now and understand that we've pretty much been stabilizing. I would say, Mark, wouldn't you say, for the last 3 or 4 months between like a 6.5 and 7.5. We can't hypothetically say they won't go up higher and all those type of things, but they've been staying pretty steady in that range. So now it's about setting you up, which we're going to talk about with some of these programs, talk about rate buydowns and how sellers can help you in that scenario. So I think the audience that is tuning in tonight, one of the big things that they're interested in, as they always are, especially if you're a first-time home buyer, are down payment assistance programs. So I definitely want to highlight one of the new ones that you made me aware of last week, Mark. And Georgia has come out with a new Georgia Dream program. So if you could explain to the audience what that is, and we can get into the specifics of what you're going to need for that.
Sure. Well, when you talk about down payment assistance programs, there are those that are used in conjunction with a conventional loan.
Right.
And then there are programs that are used in conjunction with an FHA loan. The Georgia Dream program is used with an FHA loan, and the down payment required on an FHA loan is 3.5%.
Okay.
The Georgia Dream program is $10,000 for basically any first-time home buyer, which is somebody that hasn't owned a home in 3 years.
Okay.
It's $12,500 for first responders and teachers.
Okay.
People.
So I raise your hand out there in the comments if you're a teacher, know a teacher, first responder, because you get an extra 2,500.
Sure. So it's a little bit more. Now, what Georgia Dream, Georgia Dream has an income cap. And the thing about Georgia Dream is they count household income. And that means that everybody in the household that makes money, regardless of whether they're on the new loan or not, they count that income. So if a person, let's say a spouse is on a loan, the husband's not, if the husband makes income, they're still going to count that towards their income cap. So it could be, it could actually, and that income cap is about 97.5, I believe, for a 3-family home. They do it by the number of families. So it wasn't hard to hit that, especially if you had more than one worker on the loan. Now, what they recently did was they came out with what they call the Peach Plus loan. And it's really the same loan, with the exception of they go to 150% of the area median income, which is like 160,000. So that really, for most folks, the income cap is not an issue anymore. You don't have to worry about. I mean, for most first-time home buyers, they're going to make household income of less than 160,000. So it really opens it up to a lot of people that maybe wouldn't have gotten it before.
So guys, just to summarize that, this new program that was just, I think they announced it maybe a week or a week and a half ago.
I think maybe.
That's really, really big, guys. So in your household, if you make $160,000 or less, go FHA, which is 3.5% down, pretty much either 10,000, or if you're a first responder or a teacher, there's 12,500 available to you. Now, Mark, I know the regular Georgia Dream, there was a couple of years ago, we were working on a lot of deals together for the hardest hit program, and there was certain counties that were not available, certain ones. Does this encompass the whole greater Atlanta region?
Yes, it does. There's no restrictions on
So
that.
That's another big thing, guys, because we had this hardest hit fund where they were offering at that time, I think 15,000, but it gradually went from most of greater Atlanta to like parts of Clayton County, parts of Douglas, then that went away. So this is big news. 160,000. If you make 160,000 or less as a household of two, or three, right, Mark? You could do up to three.
Right. And but I would use 160 as kind of the watermark.
So now let's talk. One person just has a question. Do these programs require a class to be taken?
Typically, all of them do, but it's not like you have to drive somewhere or spend your evenings doing it. They're just online classes that, from what I've heard from most clients, take maybe about 3 hours.
Exactly. So it's not like you guys got to be like, oh my God, I got to study for this exam and I got to pass this thing. It's really it's from what I understand, it's more like an online learning thing, and they want you to understand really what you're getting into, how mortgages work, all the ins and outs of it. So I think for a $10,000, $12,500 payout, pretty much, to help with your down payment, or we'll get into how it could be used for rate buydowns and things like that, for other programs. Pretty good trade-off for like a potential 3-hour class that you take online. You could be eating your popcorn in bed and be watching your favorite show as you click through. Now, Mark, we talked about FHA, so we talked about what the 3.5% means, but I'm sure there's a lot of people out there that are wondering, what credit score do you need for FHA to qualify for a program like that?
Well, on Georgia Dream, the minimum score is 640. Now, they have two, basically, and Georgia Dream has improved on this from what they had, I guess going back 3 or 4 months ago. They do put a restriction on the debt to income ratio if you have less than a 700.
Okay.
If you have less than a 700, but they now go to 45, which is more reasonable. Before it was, I won't go into all of it, but it was more restrictive. Now they're allowing you to go to a front and back, in other words, total debt ratio of 45. Now, if you have a 700 or above, you can typically go to 55% of your income.
Okay. So that's big, guys. And what that means, guys, when we're talking about these debt to income ratios, Mark could probably explain a little bit better than I do, but think about your debt. Think about, do you have credit card debt, the minimum payment? Do you have student loan debt? We'll talk a little bit about how you should lower that through what's called an income-based repayment plan. Do you have car notes? Do you have all the debt, right? And they're going to be basing it on how much money you make, and then coming up with a calculation to say, for as an example, if you did have an over 700 credit score, and you can go up to a 54% debt to income
Mhm.
ratio, you want to make sure that that number, based on your income and all these debts that you have, will get you that number, right, Mark?
Sure. Just, a few ideas. I mean, installment loans, like automobile loans. If they are at 10 months or less, then we don't count that payment. Georgia Dream doesn't either. Um, and not everybody's in this boat, but, one thing you can do is, if you're maybe 13 payments from having it paid off or 14 payments, maybe you make a few extra payments so that when you apply for the mortgage, it's at 10 months, or I'd say even 11, because they'll allow you it to be at 10 months by the time you close. So that's a little something you can do. The
Okay.
other thing is the IBR, and I would recommend this to anybody. It's called an income-based repayment plan. And what I've seen with those, if you apply for an income-based repayment plan, you'll generally get it, and it dramatically lowers the required payment on your student loans. So that's one thing that I would recommend everybody do. I mean, you may choose to pay more. You may choose to pay $300 a month, but oftentimes that income-based repayment plan is much less than that.
Right.
I mean, they have a $50 a month payment, and that's what lenders use to qualify.
So that's really important, Mark, and I want to make that a point, right? So say you guys have student loan debts of, you've been paying this $500 a month, $500 a month. Hopefully you get one of these, they've been forgiving a lot of the student loans, so hopefully you'll get being able to take advantage of that one of these days. But if not, they do with this income base, they're going to be looked based on your income. What's the lowest that you have to contribute? Like Mark said, that doesn't mean like, hey, I've been making these $500 payments. I'm pretty close. I'm probably like 3 years away. I don't want to have quote unquote a lower payment. What you want to do is get that IBR number down from that 500 to maybe 125, 175, whatever. This is for the purpose of qualifying for a mortgage. Now, once you have the mortgage, once you do, you know your numbers, you can still make those $500 payments and pay it off, quicker and all that kind of stuff. But for a mortgage purpose, what you want to do, guys, same thing when you have credit card debt, which I wouldn't recommend even going into buying a house with like loads of credit card debt. I'm sure Mark would agree too, because part of being a homeowner is it's now your responsibility to fix things, to plan for repairs, for maintenance. We'll talk a little bit about increased property taxes, things like that. So you never want to like max yourself out. You want to show that you're not using credit cards as a crutch. We've all had to use them at some time, pay Peter to pay, steal from Peter to pay Paul, all those type of things. But when you're setting yourself up for a mortgage, you want to show the best portfolio to a mortgage lender. So we'll talk about some strategies for that. But one thing I want to talk about too, guys, is Mark said 640 or higher typically for this $10,000 or 12,500 for this uh, Georgia Dream program. Now, Mark, say somebody goes for a pre-approval with you and they really need that, 10,000. They make, even really good money. They make the 100,000, 75,000, 125,000, all the way up to potentially this 160 with them and their spouse. What can you do? What could you offer if somebody came to you and said, I'm not a big credit card user. I don't have this amazing credit history, so my score is showing up like at 625. What tools do you have to try to help them, guide them to get to that 640 or higher, or say they were at 685 and you're trying to get them to above 700?
Well, we have great tools for that. And not all lenders do credit rescoring. Ameris Bank does. We're not the only one. There are other lenders that do it too. But I think it's important that you probably ask, if you're in that situation and you speak with a lender, you probably want to ask them up front if they allow or help with credit rescoring. Now, whenever we pull a credit report, it's going to pull your three credit scores. Most everybody has three credit scores. And when we pull a report, it's got a number underneath each score with a plus in front of it. And it tells us how much your credit could go up. So the typical credit report, let's say that you do have a 625, you know, underneath that, it may say plus 43. So I can easily, I mean, same day, go on the credit bureau website and pull a step-by-step plan that will tell you if you do these things, you'll have your credit score will go up 43 points.
Wow.
It is almost always paying down a credit card that is very close to the limit. So if you have credit cards that are very close to the limit, it's usually paying them down. It doesn't oftentimes require you to pay the card off, but depending on your situation, and sometimes it's a small amount of money, depending on how close you are. I mean, you may have a card that has a $1,500 limit and you owe $1,200. Well, you may only have to pay that down $300 or $400.
Right.
On cards with higher limits, it may be a little more, but you know, most of the time it does not require you to pay the card off, but it just requires you to pay it down.
Exactly. You know, from personal experience, from doing this now for dating myself like 21 years and seeing all kinds of files and dealing with all kinds of talking to different mortgage lenders, and you know, I'm big into all the different finance shows. In general, guys, I want you to keep a really simple formula to when it comes to credit. Now, I can't help you if you don't pay your bills. I can't help you if you're maxing out your credit cards. And I can't help you if, you know, you're doing things like, you know, we'll talk about bankruptcy and all that type of stuff, which we shouldn't really be talking about for buying a home. But I just want you to use this one formula and you'll see huge improvements. So MasterCard, Amex, Visa gives you $1,000 credit limit. The worst thing you can do is spend $1,000 and then just start making the minimum payment on that. It's showing the creditor that you are struggling, you are paying the bare minimum, and you've maxed out your credit limit. What you want to do in that example is they're looking at a 30% or less level. So if you have $1,000 with Amex that they gave you, you should not go over $299. That's 29%. That's going to keep you in a good, you know, grid score. You'll probably see a jump up in your score. Now you could bring that down to under 20%, so $199. And then finally under 10%, $99. That's when you're going to see the biggest jumps in your score. So when Mark is pre-approving you and he says, you know what, you know, actually your show, like you have really no delinquencies, you're paying things on time. Maybe you just don't have a, you know, a long credit history. You've been scared of opening these different lines of credit. He's going to be able to tell you with that tool that he has, maybe you are that person that has put $800 on that $1,000 credit card. And he says, literally, you pay this down $500 to that 30% limit, you're going to see your score possibly jump up. We've seen it jump, right, Mark? 5, 10, 20, 25
Yeah,
points, you know?
yeah, and you know, I think it is important. I mean, when you speak with a loan person, with somebody, a mortgage loan person, you know, part of that job is advising you on that. You know, if your credit's at an acceptable level, they tell you, look, it's good enough. But if it's not, you know, they shouldn't let you off the phone without telling you, look, if you take these actions, you can get, you know, your income looks good. Every part of this is good except your credit. But if you do these items, your credit score will go up to this amount and you'll be fine.
Yeah,
Uh,
absolutely.
like I said, some lenders don't do it because the thing with credit rescoring is the client or borrower cannot be charged for it. And quite frankly, it can be rather expensive. It can be
Yes.
$600, but the lenders do not pass that on. They can't. So there's a lot of mortgage companies that don't do credit rescoring for that reason because it's an additional expense. So I think, you know, if you know you've got a 780 credit score, this is somewhat of a non-issue. But
Absolutely.
if maybe your credit's in the mid sixes or something, or even the low sixes, you need to work with a lender that does credit rescoring.
Absolutely. And that's the key, guys. You know, going it alone, you know, so many, it's amazing. And it's really not that unbelievable because we've talked about this at Great Homes ATL University, talked about this on other lives that we've done, but they really just don't teach you this in high school. They don't teach you a lot of this unless you take a course in college. And this is so fundamental to the economy and, um, stopping that cycle of renting and really starting to be able to get in the home buying and home maintaining and multiple properties to grow your portfolio is always been this credit. And so I need you guys, number two, to understand that there are three credit bureaus and they're going to use the middle score of those three credit bureaus: TransUnion, Equifax, and Experian. You guys probably have heard of it. Mark, could you explain what score and what part of those three scores that they're going to be looking at?
Well, generally, most people will have three scores. Occasionally, if you're not much of a user of credit, you might have two scores. But when you have three scores, the lender uses the middle of the three, not the lowest score, not the highest score, but the middle score. If you have two scores, they use the lower of the two. Um, the credit, one thing I want to point out, because this comes up quite a bit, there are a lot of information out there that will give you a consumer score. I don't know what the purpose of a consumer score is, but you see these on your
Like
credit.
a Credit Karma type of thing? Yeah.
Well, Credit Karma, you see a lot of times with your credit card companies, they'll give you this.
Right.
But the misleading thing about it is that's not your real credit score.
Yeah.
A lender's score, whenever we pull credit, it pulls a lender credit score, and that is your real score. The consumer score is basically worthless, and I don't even know why people are issued that. Now, I've seen cases where the lender score was actually higher than the consumer score, and I've seen it lower. But you cannot rely on Credit Karma. You cannot rely on the credit card companies that say your credit score is now this, because they're not your real credit score.
Right, exactly. And I think, as I said, like you guys, it does amaze me sometimes when people do go for their pre-approval and you just missed your Comcast bill and you just missed 5 credit card payments in a row. Like, you guys have to know common sense, right? In that situation, you have not been a good steward of your credit. But there are cases, right, when we have made mistakes in our past and you are rebuilding and stuff like that. But if you just use, like I said, the rule of thumb of keeping those ratios 30%, then 20%, then 10%, if you can, paying things on time, not like opening up the Kohl's credit card, the Target credit card, the car note, like all these lines of credit all at one time, because you're going to get ding, 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 ding. But when it comes to a mortgage, you actually have a time period where you could shop for a mortgage. And it's so important to not, like Mark said, to be looking just, like I said, it's a reference tool. You'll kind of know if you have a pretty good consumer credit score, like you're making payments on time, stuff like that. But you really, for when it comes to a mortgage and starting the home buying process with us, you can't take any shortcuts. You have to actually have the conversation and have your credit pulled with a lender. And in our case, we love obviously working with Mark Scarratt because as he's been explaining to you all night, he cares and he's gonna try to help you get your score up where it needs to be. I've seen him work miracles, as a really well qualified buyer that still was maybe 10 or 15 points off of getting to another level, a better interest rate, a better program. And maybe we haven't found a home for them yet because it's been a hot market for 3 or 4 weeks. And then all of a sudden, the consumer or the client of ours, you know, hey, Mark, we found a home. We're about to put in the offer. Hey, just an FYI, I paid, a credit card off last month. And like Mark said, he could do a rapid rescore. And all of a sudden, you're in a better position. So that does happen too, right, Mark? Even
That does happen.
as we have gotten pre-approvals. Yeah.
Yeah, because keep in mind, if you pay something off, it's usually at a very bare minimum 30 days to 60 days before it shows up on a credit report. So it's a good idea that if you have paid something off, to make the loan professional aware. So, hey, look, I know you're seeing a Chase card on there with $2,000, but I paid that off last month. Because we can do, if it makes enough of a difference to get you maybe a better rate or get you qualified, we can order a rapid rescore on that and get it updated sooner than 30 or 60 days.
Excellent. Excellent. So, guys, that's the credit talk of this part. Just to summarize before we go into the next program, this is that new Georgia Dream. What's it called, Mark? The new one called?
The Peach Plus loan. That's what
So it's called Peach Plus.
Plus, yeah.
To summarize it, to put some bullet points, you're looking at FHA loan,
Right.
640 or higher. The next level being 700 or higher.
Correct.
When you get to 640 to 699, you're looking at a debt to income ratio of 45%.
Yes.
For 700 or higher, you're looking at going all the way up to 54% debt to income ratio.
55.
You're looking 55%. So it gets you that 1 extra percent too. And then you're going to your income. So for the income for the household has gone up previously for the regular Georgia Dream in Greater Atlanta is about a little over 97,000. Now it goes up to about 160,000, guys. And when you get that, when you get those factors, 640 or higher, 700 or higher, 160,000 or less, on a silver platter for you is going to be $10,000 for the down payment assistance program. And if you are like an emergency worker, right, Mark, or a teacher, it is $12,500.
Correct.
So that summarizes that. So write those notes down, guys. If you're watching this video back, make sure you are getting ready to, we'll talk to you about how you'll be able to run your numbers with Mark as we go along. But the second program we are going to talk about is specifically from Ameris Bank, and it is a grant program that has been an absolute game changer for a lot of our clients out there. Mark is going to get into the very specifics, but just, so giving you some overarching numbers, guys, is going to potentially give you up to $12,500 for down payment assistance or used towards closing costs. We'll talk a little bit about rate buydowns and things like that, but that's a significant amount of money for people. So as an example, if you make good money, you have good credit score, maybe you do or don't have a relative that would, be willing to help you out. But after you run the numbers with Mark, you're still $7,000, $8,000, $10,000 off from really where you need to be to close on the loan. This program is really going to be a game changer for you. And what's really exciting about this program, it used to be like a map-based program, but now it's once we have an address and we're looking at potential, well, even before we look at potential properties, where you currently live, if you rent in the greater Atlanta area, have not owned a home for at least 3 years, then you're considered a first-time home buyer. Even if you've owned a home 4 years ago, 5 years ago, but you have not owned a home in your name in 3 years,
Right.
You are considered a first-time home buyer again, right? So, Mark, talk a little bit about the difference between the Georgia program and now this Ameris program, because if memory serves me right, this is more focused towards the conventional loan.
Yeah. So we talked a little bit about FHA down payment assistance programs, which is primarily Georgia Dream, although there are a few others. But I like Georgia Dream because of the income cap. Some of the other ones have such a low income cap, it's very hard to be within that. But conventional loan programs, we actually have 3, but there's 2 we'll talk about. The 2 that we have are both 4% of the sales price or 12.5, the lower of the 2. So typically that's about a $315,000 home to get the 12.5. Now, the difference between conventional is you can put down, if you're a first-time home buyer, 3% on a conventional loan. So in this case, if you're getting 4% in down payment assistance, The 3% of that will cover the down payment, and you've got 1% that will pay part of your closing costs. So, with FHA, you have to put 3.5. With conventional, it's only 3. Now, the key thing about these programs are with conventional loans, they do require higher credit scores. For most of what I've seen, you need to at least be in the low 700s. Most of the time, if you're in the high 700s, it's going to do it. If you're in the low 700s, most of the time you can get it. Now, one of the programs is dependent on where you live now, where you're renting now. And it's in a lot of minority census tracts. And we can figure that out if you give us your address. The other program does not matter where you live now, but it's got an income cap. And that income cap's in the low 90s. So, we would tailor it to which one best fits. They're the same amount of money, so it doesn't really matter which one you take. But, to me, the better one is probably the one that's based on where you live now. Mm-hmm. Because if you're eligible for that program, there is no income cap. You can make $300,000 a year and still get down payment assistance if you're in that census.
Is there a minimum time frame that you have to have been renting or staying with family members to qualify for that program? And what are they looking for? Like utility bills in your name? What are they looking at?
You can use a utility bill. They just want some, even if you've been there a month, it's like you're eligible for the program. They just want some proof that that's your address, which oftentimes a utility bill would work.
So let me give you guys a real life client this year that we did this program with Ameris. And then I'm going to take a little break, have Mark talk a little bit more. And then I'm going to talk to you about maybe putting a strategy together to help get you this money, especially like Mark said, if you are that 700 plus credit score buyer. So real life client, real life scenario. I'm not going to put out names or anything like that. So a question just came in: would somebody from a different state be eligible for these programs? No, you have to be a Georgia resident, right, Mark?
No, if they're, that is a national program, but if they're in one of the census tracts in another state, they can be eligible.
Okay. So the census tract, like say you're living in South Carolina or something like that, then you could be eligible for it.
Yeah, because it's a Fannie Mae or Federal National Mortgage Association program.
Okay.
And they have the data on the census tracts they use.
So you could. It's not just in Georgia; it's throughout the United States.
Right. Yeah. And we do lend in other states, but for the purposes of this, you could live in another state if you're in one of the low to mod census tracts.
That's really exciting, guys. Even I didn't know that. I thought you had to be in Georgia, so that's really, really exciting. So let me give you guys one of our actual clients that closed with Mark and his wife back in January. So this has been, like I said, a game changer for a lot of people. So he had a score, I believe, somewhere well into the sevens. It must have been probably about 720, 740 or higher. And he was a conventional borrower, and he lived in Stockbridge, Georgia, which is, for anybody that is not familiar with Georgia, is like southeast of the airport. Sure. A lot of times for greater Atlanta, to give you context, it's a lot of communities east, west, and south of Atlanta, with even pockets inside the perimeter, like the West End, Cascade, East Point, things like that. But there are even, surprisingly, I've seen pockets, I've had clients qualify in pockets of Marietta, Powder Springs, Douglasville, Hiram, Dallas, Georgia, and even a small little quadrant west of, I think, even East Cobb, which was really surprising. But so it really is key to make sure Mark knows exactly, where you live. So our client was living in Stockbridge, had that credit score, had nice reserves saved and everything like that. But why would you ever turn down, right, as your primary residence, the opportunity to get basically, quote unquote, we'll talk about how it can be not free money when you have to, prorated stuff. We'll get into that, the caveats. But for all intents and purposes, if you live in the house for 5 years, they're really focused on making you a first-time home buyer. They want
Right.
to encourage home ownership. So this is not, it's a really great program. So like investors can't sneak in the back door and all these multinational corporations and stuff like that. You, the little guy, can get this money. So even if you had the money saved up for your down payment, closing costs, wouldn't you rather spend some of that to furnish your house and give you the reserves that you're looking for? And then the other end of the spectrum, if you haven't saved up enough and you're, like I said, 5, 6, 7,000, up to 12,500 short, this could be a game changer. So my client was in Stockbridge, had the numbers and everything like that. We went out. He really wanted to be closer to the city. He really wanted to be in Cobb County. So we ended up starting to look into Vining, Smyrna, Mableton. We didn't go as far out as Powder Springs, but we ended up finding something like right on that Mableton Smyrna line, a really beautiful resale, 3-level finished basement townhome that was priced well into over, I think it was like 450, 460 range. And we were able to get this $12,500 program. And what was great about this program, and we want to touch upon it, is the key, guys, is so many times in these down payment assistance programs, not all of them, but from a lot of experience with the income caps. There's also been in the past in a lot of the programs location caps.
Right.
And what's great about this is he, his family lived in Stockbridge and everything like that, but he worked at a hospital near Sandy Springs, so he wanted to be like on that 285 area. So you could live in, let me just call out some areas I think that would qualify: Douglasville, Fairburn, Ellenwood, Stockbridge, areas like that, and you could go buy a house. I think the maximum loan amount is like 750,000. Mark, right? I think it's around. There's
Yeah.
some kind of cap on it, but there's no income cap. So that means like you could make probably at that price point you can't make as low as like 30 or 40,000, but if you make 75, 80,000, 125,000, 300,000, 500,000, like you still get the 12,500 and you're not limited to, oh, I just have to buy in Morrow, Georgia or Camp Creek or any of those, like you could, but you could actually go to Cumming, Georgia, Woodstock, Georgia, Sandy Springs, Atlanta, Smyrna, some of the more requested areas that we get. And here you go and have 12,500. So that money, I saw a question come through, says, does the 12,000 come off the total price of the home, or is that a closing cost? No, it is actually, could be used for your down payment. So it's not money that comes off the price of the house. It's meaning that, say you had $9,000 or $10,000 down payment, you can use that 10,000 for the down payment, and then you have like $2,500 left to throw towards the closing costs. So that's a real life example, right, Mark? And you could kind of talk about what it was like working that deal and explain to people that, compared to like the Georgia Dream, where there's typically 2 underwriters involved, that this is an in-house program. So we closed that house, like I think in less than 3 weeks with that program, Mark.
Yeah, and it's 3 weeks is a reasonable time now, especially for a conventional loan. But I've had people with this product, and not a lot, but some that were coming in and making a down payment. They were coming in, they had 5 or 10% to put down, and didn't think anything about down payment assistance, but they qualified for it because there wasn't an income cap. We were able to give them another 12.5. So they put down. I know I had one client that put down. The program came out after they had already bought a house, but it was new construction. And we sort of looked at it after the program came out and said, okay, well, these people were putting 10% down, but they're eligible for this. So we were able to give them another 12.5, and it was a nice surprise for them.
That's a really nice surprise. So guys, anybody, I see a couple people saying, what's the program? I just joined late. So we'll be posting this video. It will live out on our Instagram and YouTube. But at the very end, I want to give you, well, two more things about this program I want to talk about. I want to put the little asterisk about what is a grant program so you guys truly understand. Mark, could you explain, because it is quote unquote free money, right? But we talked about that you have to hold on to the mortgage for at least and live in a home for at least 5 years. Explain a little bit about the intricacies of the program.
Well, the down payment assistance is a second loan that has no interest rate, no payment, so you don't even know it's there, and it's forgiven at 20% a year. So you wouldn't necessarily have to stay in the house 5 years, but if you stay in it 4 years, you're going to have 80% of that money forgiven. It's still worth it, even if you stayed 4 years. You've gotten more money than it certainly cost.
Exactly.
But
so in a scenario like that, just to give you guys an example, say in year 4, like you have to leave because you had an amazing job offer outside of Georgia, or a family member got sick and you just like, you need to sell the house, make some profit, all that kind of stuff. What would happen is, Curt and myself, hopefully as your listing agents, right, we have our fees and everything like that. But if your house has appreciated to a point where, say, hypothetically, after commissions, after the sale and everything like that, you have a $50,000 profit. We have one more year left on that 5-year grant program. So just basically $2,500, whatever the last 20% of it is going to be, is really just going to be coming out of those profits. So unless you're upside down in the house and stuff like that, it's really nothing you really have to worry about. So again, these are even the Georgia Dream programs and all those. Every down payment assistance program, right, Mark, for the most part, is a second mortgage, is a second lien on your house.
they all are. Not to get too technical, but one of our programs is one where it depends on where you live now. 5,000 of the 12,005 is a grant, which is forgiven immediately. So they take that remaining 7,500 and it's forgiven at 20% a year. But the majority of them, like Georgia Dream, are 20% per year up to 5 years.
Okay. So guys, when you hear this, why I want you guys to hear this is to understand that there is quote unquote free money out there, but like any program, any kind of grant program, there's stipulations to it, right? Taking a class, which we talked about, is typically an online class, sitting in your bed, sitting at your desk, clicking through, hopefully learning something from it so you know what you're getting into, right? But truly forgiven after 5 years. And so there should be nothing that you should be scared of from it. It's a 0% interest rate. And if that's the difference between getting your foot in the door to a home or helping you save money to help pay for closing costs, because on the other side of just a down payment, which we talked about at GreatHomesATL University back in February, is that you have what's called closing costs. And we're going to get a little bit into that. But that's also like, say you've saved up your 3%, 3.5%, 5%. You also have what's called closing costs. So that 12,500 could really, really come in handy to bring your cash to close, what they call, significantly down.
Right.
One other just kind of scenario I want to throw out there for you guys. And so when people were asking, like, sometimes people come from wealthy areas, sometimes they don't come from wealthy areas. We talked about how this program, it is eligible if you're relocating from out of state, if your home or rental address is fitting in that quadrant that qualifies. However, let's just take another scenario, and this could be a real life scenario, because we have clients clients that relocate from literally Tennessee, Alabama, but we also have clients that relocate from very wealthy areas like New York City and Connecticut and Chicago and Los Angeles and Miami. And so, Mark, this could be a real scenario for even people that are relocating here. Say they already have their job lined up, or they have a job transfer, or they could telework from Georgia and they've gotten approval from their employer. So, say in this scenario, somebody is from New York City, they make $250,000 or $100,000, whatever the case may be. They have a 740 or higher credit score and they're going to relocate to Atlanta. They say they're watching this live now, or they've seen our different programs that we've put out there, and they watch our content. And they schedule a consultation with us. They schedule a pre-approval with you. And the scenario is this: they're coming from New York City, again, 740 or higher credit score, 45% or less debt to income ratio, and they have a relative that stays in Fairburn, Georgia. They come to town and they say to their relative, "Hey, I want to put the electricity bill in my name, help you out. I'll even, pay a little bit for, staying in the room if you wanted to. Or I am going to do a month-to-month lease." So those two scenarios, and I now have a utility in my name. They come to you, you've already worked with them. We can put a strategy together to wait another month, 2 months, them sending you that utility bill. And now all those other things considered, right? They have the income, they have the credit score. They can now qualify only being here for a month, 2 months, 3 months by either staying with a family member or doing a month-to-month lease, 12,500 theoretically, right?
That is correct. There's no minimum on that, but typically it takes, a month and a half to get a utility bill in your name. But
Right.
yeah, that works. There's no minimum. You don't have to have been in the home for 2 years.
That is huge,
Yeah.
guys. So this is a game changing, and it's a Maris specific grant program. I want to make that clear on this one. 12,500, some more bullet points, just like we did on the Georgia program. So this one could be here mostly in demographics are minority or low income areas, and they're trying to encourage and give a helping hand to get you into home ownership. You've been a good steward of your credit. You've been saving for your down payment, but you don't have that relative that can gift you funds. You just have not had enough time to save up, but you have a good chunk of money. This 12,500 could make a difference. 700 or higher credit score. Let's start with that. 740 or higher, even better. Debt to income ratio, Mark, 45% or less.
Um, you can actually, what I've seen on that program is up to 50.
Up to 50% debt to income ratio. That
Most
helps a
cases,
lot.
you've got, a credit score in the 700s. I've gotten many approvals at, 49 right up to 50. 50 is the cutoff. With conventional loans, you'll never get an approval above 50.
Got you. So
Even
that's
if
even good.
with an
Because a lot of the other conventional programs, they've been pretty strict at 45% or less. So now with this program, potentially 50% or less for debt to income ratio. That's really, really big. Um, and then it's really like game on, guys. It's like, do you currently already rent in one of these areas or stay with a family member? Are you a first-time home buyer, never owned a home or haven't owned a home in your name in at least 3 years? Conventional loan. And we could put that strategy together over like a 2 to 3 month period. Or if you're pretty close, if it takes a little bit longer to get your credit score, what's needed. This is a pretty solid program because, again, no income limits, mortgages up to $750,000, and you can buy anywhere
right.
in Georgia. We service obviously Great Homes ATL, we handle Greater Atlanta, typically an hour and a half, hour 45 minutes, typically max, unless it's an amazing scenario. Somebody wants a $5 million home 2 hours away. I'm sure we'll we'll go out there, but typically, like I said, about an hour and a half, hour 45 minutes within Atlanta. So this is, I think, really, really a game changing program, and I think we've had real life. I think we've had at least 5 or 6 deals that we've done with Ameris on this one, and why we wanted to come on here and share it with hopefully hundreds and thousands of you is because this guy, me, and this guy are going to, at the bottom of your screen, are the ones that have this program and is going to be able to help you, guide you to the program. And again, we have announced the Georgia program. Georgia, what's it called again, Mark?
The Peach Plus loan for Georgia.
Georgia Peach Plus. And again, that was 10,000 FHA based. You could do conventional, but if you're going to do conventional, let's start looking at this Ameris one.
Yeah, FHA. Georgia Dream doesn't work well with conventional loans. It's primarily FHA and VA.
Okay. Question coming in from guys. You could definitely put your questions in here. We're gonna talk about a few other, I think, important things. We've already talked about credit scores. We've talked about where we see interest rates. I want to get into calculations and a little bit about rate buydowns next. But talked about 2 great down payment assistance programs. But bring your questions if you want. Let me know where you're Instagramming in from, what your time frame is. And towards the end, I'll let you know how to get in touch with Mark and us. So the first question that came in, Mark says, how does that work if one spouse has a 700 plus score, but the other spouse has poor credit?
It's going to go by the lower of the 2 scores of whoever is on the loan. So, hopefully we could just put the higher score borrower on the loan. You could always, have your spouse on the deed. But if we could, they're going to go by the lower of the 2 borrower scores, and that's pretty standard in the mortgage business.
And why they do that, guys, is because you are, the home is collateral to the bank, right? So the mortgage bank, the lender, whatever, the mortgage broker, who actually sells the loan in the marketplace. But think about it yourself. If you had $300, $400, $500,000 to loan out to somebody, and they came to you and said, "Hey, me and this other person on a loan, whether it's your partner, your spouse, your cousin, your mother, whatever the case may be, you both want to get this loan." They're going to say, "Okay, show me your paperwork. Show me how much money you make. Show me your payment history." So if you, as one spouse, has been just either lucked out or just always been financially sound, paid their bills on time, kept really low credit limit to credit ratios, and you have 700s, 800s credit scores, which is top notch, and your spouse doesn't, that really does kind of drag you down in the eyes of a lender. So if the person with the better credit score has enough income to qualify for the type of house that you want, then, like Mark said, go with that one person, your wife, your husband, your spouse, your partner. Doesn't have to feel left out because they can be protected in the event of, your death or anything like that, or God forbid, a divorce or anything like that, that they feel protected, that that's not going to go to probate, or it's not going to be, they'll have some kind of right to it. But for a mortgage purpose, they're going to look at the lowest of those basically 6 scores, right? Yours and your spouse. So kind of plan on that. And if you're any money short, maybe your spouse can help out with that, like gifting funds, right, Mark, or something like that.
Yeah, and I'm always going to tell people that, even if it's not a down payment assistance program. If I see, a client, a married couple or whatever, and one's got a very high score and one's got very low, and I see that the income from the one that has the high score is enough to qualify, I'm going to mention it. It doesn't mean you have to do it, but I'm going to tell you, look, you'll get a much better interest rate, or you may be eligible for down payment assistance if just, the one of you goes on the loan. And you can both go on the deed to the house. If you both agree to that, you don't have to be on the loan to have ownership in the house.
Gotcha. Now, just talking about, before we get into rate buydowns, talk a little bit about what, we're all focused on this down payment assistance money, all this type of stuff. I want to, break down a couple of different things, and then I'm going to have Mark explain a few things as well. But how mortgages have worked for many, many years, to avoid private mortgage insurance, you have to put 20% down. Now that number, whoa, that's big to a lot of people. It's typically people that have sold another house, have come into some money, are coming from a very wealthy real estate market, maybe have lived in their house in Los Angeles or New York
Sure.
or Minnesota, right? And they sold their house and their mortgage was down to like $100,000 balance, and they sold the house for $500,000 or $800,000, right? But for you out there, which I'm sure a lot of you guys are first-time home buyers, this is where a lot of these programs are going to help you out because, like Mark talked about, 3%, as low as 3% for conventional, 3 and 5% are typically the ones for conventional, and then a federal government-backed program, FHA, Federal Housing Administration, is 3.5%. But the other responsibility of the buyer, and I'm going to talk to you a little bit after we talk about rate buydowns and stuff and how we do those calculations, how I, as your representative, as your agent, can help you with some of the negotiation and why it's really important to have representation. But Mark, can you share the other side of down payment, which is closing costs, and how much in total on average between closing costs and down payment should somebody at least have a goal to save up for?
Well, when you buy a home, you've got three things. You've got the down payment, you have the closing costs, and the closing costs, only part of them go to the lender. There's certain expenses that go to the state of Georgia. They go to the attorney, the closing attorney that closes the loan. You have title insurance. So closing a cost is like 12 or 13 items, and depending on the loan amount, they're typically somewhere around 3%. That's typically what closing costs are. Sometimes a little less if it's a more expensive home. So you've got your down payment, you've got the closing costs, and you have what you call prepaids. Now, prepaids are not charges, they're not fees. They're just, they primarily are the taxes, the property taxes on the home and the homeowner's insurance. So you need to have a year's homeowner's insurance policy. So that's a prepaid, meaning that when you buy a home, you need insurance the first day that you own it. God forbid that the home would burn down, but you can't have a scenario where the home burns down without having insurance on it. So prepaids are money that you set aside to pay the property taxes, because the property tax bills are typically due late in the year. So the lender might collect 4 or 5 months of property taxes so that with the rest of the payments you make between now and then, you've got the 12 months that you need for the lender to pay the property taxes, say in October or November.
Gotcha. So on average, guys, those closing costs, we talked about escrows, lender fees, attorney fees, the government is going to get their money and stuff like that, as far as, having to process things with the courthouses and stuff like that. On average, you're looking at about 3.5% of the sales price, just like you would FHA. So what I want you guys to think, now again, we talked about down payment assistance programs. We'll talk a little bit about gifting in a little bit as well, but I want you to, as you're starting to calculate, these are really feasible numbers for you. You won't know, this is the whole point, you won't know what you qualify for until you go through Mark to, run all these numbers that we're talking about. But let's just think of some of the, the worst case scenarios, or the, like, always want to think about how much I really need for this transaction. And so if we're looking at an FHA loan that requires 3.5% down, you should add another 3.5% for your cash to close. So as an example, you would take a $300,000 house or a $350,000 house and simply put it into your calculator, 300,000 times 0.07, right? 3.5 and 3.5. And if I do that right now, I have my calculator out, 300,000 times 7% is about $21,000. Now, again, that money, you might say, like, oh, that's actually much better than I actually thought. Or that could be like, well, I only have $10,000 in my checking account, but I actually have been working the last, 7, 8 years. I've accumulated $50,000 in my 401k, right? Or my retirement account. That actually is money that you can use to purchase your first house. So if you had $50,000 in your 401k and you had $10,000 in your savings, hypothetically, you can have the cash to close at that point for the 21,000. Now, the game changer in that, right, is what we talked about. If you were ending up getting 10,000 from the Georgia program, that brings that down to $11,000 cash to close. If you get the $12,500, you're under $10,000 to buy a $300,000 house. Pretty incredible, right, Mark?
Yeah, yes. And I tell you, particularly with first time home buyers, it is quite common that people will use their 401k. You can either borrow from the 401k or withdraw the money. And I believe if you're using it to buy your home, you don't get hit for the 10% penalty.
Exactly. Always, check with your accountant, your employer. But from my own personal experience, when I bought my first house, that was the scenario. So if you have money in your a stock trader, investment accounts, E-Trade, Charles Schwab, any of those, if you're 401k, those are what they call your really liquid assets. You have access to that money. So not just your savings account, not just your checking account, but your investment accounts, your retirement accounts. Now, Mark, what if that person, uh, we're just going to use that number again, 21,000, and this person had actually saved up 15,000. They just, for their own purposes, their own reasons, they don't want to touch their 401k. They have all the other money set aside, that other 10,000 in their savings account because they want to furnish the house. They want to have that rainy day fund. Can they reach out to a relative, a friend, anybody that wants to help out to have that money gifted that they are maybe $6,000 short?
Yes, I mean, gifts have become more and more usable. Generally, typically with gifts, it does need to be a relative. I mean, even if it's a cousin, they accept it. In some cases, it can be someone other than a relative, but it depends. If you can show a strong bond, like it's a fiance or somebody of that sort, but for the most part, it's from a relative. Basically the gift letter that you and the relative sign says that you're not obligated to pay the amount back. That doesn't mean you can't pay it back, but they have to sign something saying that you're not obligated
So
to
there's
pay
a
it back.
true gift. It's a real gift. Yep.
A loan.
Exactly. Can't be alone. So again, on paper and so say your grandmother, right? Your grandmother, you're 25 years old, 30 years old, 35 years old, right? You've been a good kid, you've been working, you've been saving, but you also travel a little bit and stuff like that. You still want to live your life and you are $5,000 short, right? Hopefully you get one of these programs that we're talking about and you don't have to go to grandma. But grandma has been like, you know, she has lived in her house, she's had it paid off for many years, and she would like to gift you to help you start that trajectory like she did of, you know, owning a home and the pride of it and sharing memories and how she got to a point where she got it paid off, and she wants to give you $5,000. Grandma cannot take that from under her in her empty coffee can that she's been saving that money for, or under her mattress. It has to come from a verifiable source. So, Mark, in that situation, if she had to show her bank statements, right, and showing the money coming out.
For the most part, now on conventional loans, they kind of relax that.
Really?
You with conventional loans, if you get a gift and if the person who's giving you the gift wires the money directly from their checking or savings account to the closing attorney, a day or two before closing, they don't require the donor's bank statement.
That's on a conventional
That's
loan.
on a conventional loan.
Okay.
That means that
Not FHA, not FHA, just
no,
conventional.
not on FHA, but that means that the person could have had it in a coffee can as long as they go put it in the bank and then wire it to the closing attorney. They allow that.
That's the key, guys. You're not going to show up with grandma's coffee can at the closing table at the attorney's office.
Right.
It has to come because, you know, this is money that's being exchanged. This is money that's being paid for, an asset that's being backed by a bank. So they don't want to, you know, think that it's coming from illegal means or the local drug dealer or anything like that. So that's how their level of protection is. Well, it's coming from a bank, being wired to the closing attorney. So grandma is not the coke dealer on the corner.
Yeah. They also, I think, part of it too is they want to make sure that you're not borrowing the money.
Exactly.
They don't know about it. A lot of people don't know this, and it's very, very rarely used, but you actually can borrow money for down payment. Let's say that you had an automobile that was paid off that, was worth $20,000. You could actually go to the bank and borrow money on that, and they would allow that towards the down payment as long as you qualified with that new payment.
Great information. One of the last topics I want to talk about tonight. This has been a great, I think, really informative, and it will live out there, and we'll post it on our Instagram and on our YouTube channel. Rates, right? We talked about at the beginning, and they are on the higher end now, but they have been staying in that 6.5% to 7.5% range. We don't know what's going to happen, but one of the solutions to that potentially is what's called a rate buy down.
Right.
And so I want you guys, and you'll be able to run some of these numbers when you have the conversation with Mark on your pre-approval consultation with him. But let's just say that today's rate is market rate for credit score purposes, all that kind of stuff, is 7.5%, right? So I personally, and you'll be able to use this tool and of course Mark as your resource, but I like to use this tool called mortgagecalculator.org. And it's been a really cool tool, and a lot of real estate websites have their own mortgage calculators now. So I just want to give you guys a scenario of potentially what a payment would be at 7.5%. You can tell me, Mark, if this sounds about right in the numbers I'm going to be using. So in this scenario, I'm going to be using $350,000 home with 3.5% down at a 7.5% interest rate. It's a 30-year mortgage. I'm estimating property taxes to be about $4,000 because here in Georgia, taxes typically range between probably 1.2 to 1.5%, depending on the county and the city you're in. Some are more attractive than others, like Cherokee County is pretty cheap, typically like 1%. If you're if you're over, like if you're a retiree, if you're watching this and you're a retiree, sometimes some counties, once you reach 60 years old or 62 years old or 70 years old, the school taxes go away. So you save a lot on your property taxes there. But in general, for the everyday home buyer out there, you should kind of look at the high end about 1.5, but probably be in that 1.2 to 1.5 range. So did 4,000 for property taxes. Um, how much would you say, Mark, for PMI? About a 0.5%?
Well, the PMI is based a lot on credit score. And quite frankly, if you have a very high score, it can be a very small amount. But, I would probably say a 0.5% would be a good estimate.
Okay, a 0.5%. Homeowners insurance. This is where you could shop around, but say you do with your car insurance carrier and you have good credit score. It's pretty reasonable,
Probably
like $850. Yeah,
$1,800. I think I've seen a lot of that in that price range.
yeah. So I did that. So the monthly payment on that would be $2,906, around that range. Like I said, give and take depending on the property taxes and homeowners insurance. Now, what if that's the market rate? What if you did a 2-1 rate buy down to get that interest rate down to a 5.50? I'm going to use those same property taxes, homeowners insurance, and Mark is going to talk after this about how to get that to 1 rate buy down to a 5.5. The new payment, guys, would be, let me do 3.5% at a 5.5% rate. So it's buying it down 2 whole percentage points. Brings that payment significantly, guys, down from about 2906 down to $2,462. So almost approaching $500. That's how much interest rates make a difference. So, Mark, explain a calculation of how, and I'll talk to you from the realtor perspective of how I can negotiate this, but I'm seeing it a lot in the new home market, but how even in the resale market, how this can be a game changer for you, and how you could even use some of these, uh, the Georgia programs and the 12,500 to buy that interest rate down about 2 points.
Yeah, I mean, these programs are temporary buy downs, and the timing on them is pretty good right now. There's a reason why it's so popular. And the reason the timing is good is because there's no guarantee, but it's very likely within the next 3 years, rates will come down and you'll refinance anyway. Now, what we're saying is, let's say that I think rates are more around 7.25. So let's say that you could either take the 7.25 rate on a 30-year fixed, and that's your payment for the life of the loan. But if you can get the seller to pay some of this, it's called a buy down fee, which is in the term of points. If you can get the seller to pay this, because it doesn't make sense to pay your own buy down.
Right.
If you negotiate the seller to pay the buy down, it means that instead of that rate being 7.25, you're going to start at 5.25. And for the first year, your payments will be based on 5.25. In the second year, your payments will be based on 6.25. And then in years 3 through 30, they'll be at 7.25. So what this can do is, because rates are higher than they typically are right now, this can give you a break the first 2 years until you refinance.
And then, are you qualified off of the 7.25 in that scenario, or the 5?
No, you qualify off of the first year rate.
So that's big too, guys. So say you really, really wanted this house that you saw on our website as we went out to look. And even before that, we're going to talk, because we have the relationship with Mark Scarratt here that we're talking to tonight. And I'm going to have that conversation with Mark and say, hey, this client, they're looking at a 300, they're pre-approved for 350, right? But they're really not comfortable with a $2,900 payment. They really wanted to keep it at 2,500 or less. They could go up. They qualify for that 2,900, as long as we explain about what how the 2-1 rate buy down works. Like, that's a game changer for a lot of you guys, because instead of paying a $2,900 payment that first 12 months, and only having to qualify off of the 5.25 as opposed to the 7.25, that's a savings of about almost $6,000 for that first year alone. And so how that relationship between Mark and myself, the two Marks, and that conversation could help is because when I have a Zoom consultation with you and we're talking about, hey, Mark, I want to look at a house in, let's just say, Mableton, Georgia,
Mm-hmm.
and I'm pre-approved for 350. Again, I can pay 2,900, but boy, that first year, that extra $6,000, I could buy some furniture, I could do some projects to the house. I really like that 2462 payment. Um, we can go home shopping now for that 350 or even 360 in this market, or 340, whatever the case may be. And because I know that number that Mark is going to give me, I believe it's about what, 2.56%, Mark?
It's generally around 2.625, 2 and 5
Two and
eighths. You know, larger loan amounts, it goes down a little bit, but for most loans, it's around 2 and 5 eighths. So you're going to try to negotiate your seller to pay the 2 and 5 eighths.
So on $350,000, guys, that's about $9,000. So again, this is why representation matters. This is why having a good broker, good agent, good
Correct.
lender, not only because of these down payment assistance programs, but understanding how interest rates work and understanding how we can get you that lower interest rate. In that scenario, we go and look at three of your favorite houses that you saw online. Maybe you already drove by them in Mableton, Georgia. If the pictures, if the interior matches what you saw on the website, you really like that house, what we can do as your agent and say, okay, we're going to look at different factors. How long has the house been sitting on the market? Do they have any other offers? What is the seller looking for? That's the benefit of having real good representation, because I can go to that listing agent and say, hey, my buyer really likes this. I've seen it sitting on the market for 14 days. Do you have any offers? No. Bring me an offer. Okay. Okay, I'll bring you an offer. How about 345 with $10,000 in closing costs, or $9,000 in closing costs? We'll call that closing costs, but it's really a seller
Mm-hmm.
contribution, which you can use towards that rate buy down.
Correct. Yeah.
And they say, no, we'll do 350 and we'll give you the 9,000. Hey, that still works for you, because it's not going to be a big payment difference between 345 and 350. And now instead of paying 2906 a month, you're now paying 2462, at least for that first year. And you know, you could use that money to buy that interest rate down. You don't have to. You could go with the 7.25% rate and have less money to bring to the closing table. But if you have your 401k, you have money saved, you've saved for that cash to close, let the seller pay that. You get the lower interest rate, and you've saved yourself 6,000 that first year, probably another 3 or 4,000 for the second
Right.
year. And then if interest rates come down, Mark, to anything less than 7.25, you've won,
Right.
in year three,
Yeah, and you refinance.
and you refinance. So that's, guys, how the rate buy down works. So you kind of take that number, multiply it by about 2.58, and now you've had the conversation with Mark. You've gone through all these scenarios that we just talked about. Maybe you qualify for one of those programs. 2 thumbs up if you do, but if not necessarily the worst case, because you know your numbers, you know the numbers to possibly get that 2-1 rate buy down. Now, Mark, one other thing for the down payment assistance programs, the 12,500 and the 10,000, can you use that money for the rate buy down as well?
Well, on the Georgia Dream, and this is one thing that we did mention about Georgia Dream. Georgia Dream only offers the fixed rate, but you get a better rate.
Right.
Like I think the last Georgia Dream rate sheet I saw was like 6 3/8. So you get a lower 30-year fixed rate with Georgia Dream. Now, they don't allow a 2-1 buy down, but you do get a better rate than you would if you weren't using Georgia Dream.
Okay, good point.
Conventional programs, we do 2-1 buy downs on those. So if you do a conventional down payment assistance program, we have a 2-1 buy down on all of them.
Excellent, excellent. So, guys, those are some amazing stats there, and I believe too, Mark. I got an email that for veterans, VA for that Georgia Dream, I think they were offering like 5.75 or 5.5 or something like that.
It's real low. It's like 5. And
Wow.
it's just for VA folks, but you can go through Georgia Dream. Now, you do have to be in their income cap, and I'd have to check to see if they've added it to the Peach product. But they opened up recently for veterans. They can get a much lower interest rate if they go through Georgia Dream.
Excellent. Okay, guys. So to summarize tonight, we talked about how, what to look for, the CPI, right, Mark?
Yeah,
CPI, Consumer Price Index. You want to look for those every month. If those numbers, you'll know because the news media is going to say those numbers are good or bad. You want to look at the 10-year Treasury, right, Mark? The 10-year Treasury bond. Not a direct correlation, but it typically I think when we got to like 6% rates or 6.25 rate, the Treasury yield seemed to be under 4% at the time.
The 10-year is a good thing to look at it to determine the which way rates are going. Specifically, it's mortgage-backed securities, but those are a little bit harder to find. You probably have to search on the internet to get, but that is directly what rates come from, or mortgage-backed securities. But the 10-year is a good indicator of, if you see in the 10-year drop, then rates are probably dropping. You see it go up, the rates are probably going up.
Gotcha. So, like the overarching theme, guys, how we started tonight is don't get so fixated on the rates because we talked about in this last segment ways around it to drop it down a whole 2 percentage points with a team effort between the lenders and us as your brokers and agents here at Great Homes ATL. That you're going to be getting into most likely what's considered a 30-year mortgage. Now, you're not stuck with it. You could always sell a house well before the 30 years, but you should go into it. I think the message is go into it at least with the thought with a lot of these programs for owning it at least 5 years. But you're going to have so much pride in this home ownership. You're going to want to take this home and make it potentially down the road your first investment property or selling the profits to get the next level house. But this is your entry point into home ownership with the Georgia program that has 10,000 or 12,500 if you are a teacher or an emergency worker. We have the 12,500 conventional loan program, which is specific to Ameris with Mark that you're seeing here on your screen. So when you go for your pre-approval with him, you'll see if you qualify. The big benefit of that, rent month to month, stay with a relative in one of these areas.
Sure.
Mark can look up what addresses qualify that you could give them. And typically, like I said, if your scores are that 700 or higher, 740 or higher, even better, and you have good income, you have great credit scores, you'll be able to buy anywhere throughout Greater Atlanta. Fantastic conventional loan program. 2.58. That's the number you want to look at for a 2-1 rate buy down. And just one last thing we talked a little bit about the veterans and how Georgia Dream has an amazing rate on that. Mark, I want to talk about one last program because there could be people out there that are doctors or veterinarians or in the healthcare industry. Can you talk about some of the professions for what's called a doc loan, which has no private mortgage insurance and no down payment?
Yeah, the advantage of medical professional loans, and I will say, a number of lenders have them, but ours is open to a lot of medical professionals that some of the other banks do not include, like podiatrists and chiropractors. Most medical professional loans do not allow for that. But what they're looking for are fairly new doctors. In other words, less than 10 years in the profession, because the primary advantage is that you can typically do a 100% loan on these. So if you're a relatively new out of residency doctor, they know that your income is going to be high, but you haven't quite had enough time to go by to save up a down payment. So you can do a medical professional loan and not have to make a down payment.
Gotcha. Awesome. I'm going to post here in the comment section and pin it as we start to wrap up here. If you guys look at this first comment, it says, go to GreatHomesATL and hit begin process. We're excited that Curt has been working. We are revamping our website, so stay tuned for that in about a month. We are investing quite a bit into it, really going to be an amazing layout. And we'll still have this feature on a new website, but Mark is aware of this too. When people hit begin process on our website, there's going to be what's called a jot form that pulls up where you'll put in your name, your phone number, your email, maybe your time frame that you're looking for and things like that. Once you hit the submit button, Mark, as well as another one of our lenders, will be getting that email and they will be able to reach out to you. So if you're watching this now, you're watching it back, recorded, whatever the case may be, and you want to start the process with us. And I can't stress to you, all these programs we're talking about, all these credit scores, all these numbers, there's nothing better than one-on-one. Everybody has a different financial situation. Everybody has various questions and scenarios, like we talked about with spouses, with college loans, with credit. There's nobody that's going to be a better resource for you than the guy in the bottom of the screen, Mark Scarratt, with Ameris. So when you fill out that form, he's going to get the email and you could tell him, hey, I watched you on the live, or I watched back the video, or I watched you, in your video for Great Homes ATL University. Mark and Curt speak highly of you. You guys will have a great conversation. And Mark will have just how you see today. There's no lies. His demeanor is how he is. He's a very, very nice guy, very approachable, and has tons of experience, not on Instagram Live, but with the mortgage process. Over about 40 years plus, right, Mark?
Yes, yeah. I've been doing it a while. And I think I look every bit of it.
And so, you're going to get that call from Mark. Please don't. It's amazing when people hit that begin process and he leaves voicemails and emails and you don't respond. If you really want to be a homeowner and you hit the begin process button, this is going to be your first step. As you can see, he's a really nice guy, very knowledgeable. If you're there, if you're great, you got pre-qualified or pre-approved for 250, 500, a million, whatever the case may be, great. The next step is you will get a pre-approval letter sent to your email from Mark, and it will be CC'd to us. You'll get a link to schedule a Zoom consultation. So you already talked to Mark, now talk to us, talk about the areas you're looking for, bedrooms and baths, stuff like that. We'll put a plan together to go out and look at houses, get you under contract. And Mark is going to be that guy that handles your mortgage and hopefully qualifying for one of these programs. We're talking about the gift funds, talking about down payment assistance, talking about rate buy down numbers. And we're all a team in this, including yourself. It's all of us, the buyer, the lender, us as the realtors, which will eventually be closing attorneys, and everybody has that same objective to get you to the closing table, get those keys, and own your new or resale home. One last thing I want to mention too is Ameris Bank, who we partner with on a lot of our deals. They also have various builders for new construction. Mark sends me lists, and we'll probably do updated list, Mark, maybe once a month to see if that list has changed. But there are dozens and dozens and dozens of communities throughout greater Atlanta. If you want to still work with Ameris, get a lot of these programs, new construction is still a possibility for you. Actually, Mark is working on one with me down in Fayetteville for some clients that is a really good solid builder. We're about to go to drywall, I think, in the next week or two. And Mark and his wife have been along on that journey as the preferred lenders for this particular builder. So whether it's resale or you want to focus on some of these new home communities that Ameris services, we can definitely do that too, right, Mark?
Right, that's true.
Absolutely. So
that with myself or with Mark Kozik, the phone call is not going to be us trying to convince you to buy a home. We're going to present you with the information so you can know what you do, but whether it's the right time for you to buy a home. So we're not going to pressure you into doing something unless you feel like it's the right time, but we can give you all the information you need to make a good choice.
Yep. And so, we, like I said, me and Curt started the Great Homes ATL team back in 2015, and we became our own brokerage in 2020. So we've been working with Mark probably since about 2017. Mm-hmm. We've seen it all. We've experienced it all. You're in really, really, really good hands. And we've had scenarios where people have called up Mark and gotten their pre-approval on a Monday, scheduled a consultation with us on a Tuesday or Thursday, which is when we do them. And we've had people under contract, guys, on Saturday or Sunday,
Sure.
starting on a Monday. Then we've had other clients that they are, 30, 40 points off of their credit scores. Their situation changed. They got a new job offer or a bump in their salary, got some tax return money, paid off some debts. And as long as you stay in touch with us, and Mark will be following up, checking in on you too, because we create, we have a list of people that have hit that begin process button with us that stay in our, what we call our CRM. So you'll always be in touch with us. 6 months down the line, go back for their pre-approval, and then we go home shopping. And then there's people that, are in out of state and they've always had a desire and they follow us on Instagram and they are 10 months or a year away, but they maybe want to build a home in one of these new home communities that Ameris is a part of, and it's a 6, 7, 8 month build time, and they'll come back to us, 8 months before they're ready to buy, and then go for their pre-approval. So Mark, we've, I think since 2017, seen and worked through all kinds of scenarios, right?
Sure.
Yeah, absolutely. So guys, if you have any last minute questions, definitely let us know. I think we took a lot of them, and I think this was really informative. As a reminder, how we started, we have Homebuyer University, which we did a class in this past February. We'll probably do another one or two, hopefully, this year in person that we hope you can join us. But if you can't, if you are just nervous to meet up in person, or you're scared, or you're out of town, we've created the Homebuyer University actual book. It's going to be an ebook and an actual physical book that you'll be able to order on Amazon and on our website over to probably the next month once that's launched. And I think it was a great, conversation, Mark. I think it was really informative, and I hopefully could do more of these and do some question and answers, a couple times a month. And this could be the new thing, the Mark and Mark show.
Yeah, it could be Eminem.
So hopefully you guys enjoyed this. Like I said, we'll try to do some more of these now. We know Apple is the phone to use, right? for the Instagram Live. So we got that all set up now. So maybe it'll be a few M&M Live shows that we'll be doing and just taking your questions as we go along. But again, guys, I hope you really enjoy learning about $10,000 and $12,500 grant down payment assistance programs. We talked about rate buydowns. We talked about the state of the economy and how to look at the rates and all that kind of stuff, and just not get so fixated on the news and on high rates, low rates. Again, this is a 30-year mortgage. Wars, pandemics, crashes, hot markets, slow markets are going to be a part of that 30-year period. So the biggest thing, get with the right team that really knows what they're doing. Again, I've been doing this for 21 years. Kurt's been doing this now for, I think he's entering his 11th year. We have another agent uh, that Mark has actually done some great deals with lately with Gem. So follow her here on Instagram, Gem GreatHomesATL. We're interviewing more agents. So we, whoever you want to work with on the team, Mark, Curt, Gem, we're all going to be here, and with the partnership of Ameris Bank and Mark Scarratt and his wife Alexia, I think we'll be able to get you to the closing table, right, Mark?
We sure will.
We sure will. So, hope you guys had a great evening. I hope you have a great rest of the week. And again, that post that is pinned to the comment section. Go to greathomesatl.com. Fill out that form, begin process, and be on the lookout for Mark's call and email, and he'll walk you through all these scenarios for you. And then Curt and myself and Jem will take you out, and we'll go home shopping. All right, Mark, thanks so much for joining us tonight.
Thanks. I was glad to do it.
All right.
Anytime.
All right, guys. Have a great night.
Evening.
We'll talk to you soon.